When banks give loans, the biggest question they ask is whether the borrower will repay the loan or default. Default means the borrower fails to repay the loan. To predict default, there are three main approaches used in credit risk models: the judgmental approach, empirical models, and financial models. Each approach uses different types of information and methods. First, let us understand the judgmental approach. This approach is also called the qualitative approach or expert system because it depends on the experience and opinion of credit experts. Instead of using complex mathematics, it focuses on practical assessment. A common method under this approach is the 5C analysis. The first C is character, which looks at the borrower's honesty and repayment history. The second C is capacity, which checks whether the borrower has enough income or cash flow to repay the loan. The third C is capital, which means how much of the borrower's own money is invested in the business. The fourth C is collateral, which refers to assets given as security to the bank. The fifth C is conditions, which examines the overall economic environment and industry situation. This approach is useful when historical data is not available, especially for new borrowers or project finance. However, it depends heavily on personal judgment, so it may be biased and inconsistent. Next, we have empirical models. These are data-driven models that use historical data and statistical techniques to predict default. Instead of relying on opinions, these models analyze past loan records, past defaults, borrower characteristics, financial ratios, and even market information. Machine learning methods are also commonly used here. The advantage of empirical models is that they are more transparent and can be tested and validated. They can include many variables and can be updated regularly. However, there are some weaknesses. Past data may not always predict future behavior accurately, especially during economic crises. Also, some financial data is only available quarterly, which may reduce accuracy. Finally, we have financial models. These are based on financial theory and are mainly used for large corporate borrowers. They rely on market data such as stock prices and bond prices. There are two main types of financial models. The first type is structural models. These models assume that default happens because of the firm's internal financial condition. For example, if the value of a company's assets falls below its debt level, the company defaults. This means default is caused internally. The second type is reduced form models. These models treat default as a random event that can happen suddenly, like a shock. In this case, default is considered an external event. These models mainly use market data like credit spreads and bond prices. To summarize, the judgmental approach depends on expert opinion, empirical models depend on historical data and statistics, and financial models depend on financial theory and market information. In practice, banks often combine all three approaches to make better and more accurate credit risk decisions.